In a recent couple of shorts, we discussed a fun tweet about tax revenue from a wealth tax. Where is that damn tweet? Look, I'll link it later. It's all good. In these shorts, we discussed how a wealth tax influences the value of an asset. But for those unfamiliar with finance, this would have seemed wild.
As a result, it appears to be a good time to add time to our discussion of microeconomics. Armed with the tool of present values, we will be able to compare sums of money through time and work out why a wealth tax might not raise as much revenue as we may intuitively expect.
$1 today and $1 tomorrow are not the same thing. That fundamental truth means we can't just take dollars earned at different points in time and add them up to figure out how much a stream of income is worth. As a result, we want to figure out how we can value a stream of income and think how much it is worth to us right now. Let's make things a bit more concrete. Imagine you have a piece of paper and you can show this piece of paper at the mayor's office on your birthday. You receive $5 when you do, and you can do this 10 times, so over 10 birthdays. Your birthday is today. You haven't cashed in your $5 quite yet though. How much would you be willing to sell this paper for up front? Now, it would be quite wild to sell it for less than $5, as you can go and pick that $5 up right now and keep the future claim on all payments. However, it's unlikely that you would demand the full $50 that you would get from receiving $5 each year. Why is it unlikely that you'd ask for the $50? Well, you might expect prices to rise in the future, so you won't be able to buy as much. Or you may have the ability to earn interest on any sum of money you're paid now, and so could turn it into more money. In the same vein, you may have an investment opportunity, which will give you a rate of return if you had that money now and invested in it. Or you just might simply prefer buying things now rather than in the future, what is called time preference. As a result of this, you will discount future sums of money on this basis, implying that the present value, which is the formal name for the sum you would accept now to sell the rights to these future cash flows, will be less than the sum of cash amounts.
When working everything out, we are going to stick with situations where the future cash flow is known. Uncertainty is very important, but for now, all ideas of expectations and beliefs are left to the side. The best way to think about a present value is to start in the future. If you had a sum of money now, what sum would be worth the same for you in the future? Start without inflation or any concern about when you consume. You'd probably only think about the number of dollars that pop out. Take $100. You can invest that in an asset that gives some rate of return R over the next year. Or you can keep it in the bank and earn 5%. What would R need to be greater than to lead you to invest the money? That's right, 5%. Another way of stating this is that the future value of the asset needs to be more than the sum of money you'd have otherwise. We can calculate both of these future values by adding the initial investment to the return on that investment. This can be rewritten as the initial value times 1 plus the rate of return. This same idea holds when thinking about changes in prices and a bias for consuming now. Imagine the price of a soft toy rose by 5% in a year. In that case, you would need 5% more dollars to purchase it then. The future value would be 5% higher, as that refers to the same consumption. Furthermore, if you just value the soft toy more now, you know you would need more things in the future to compensate for waiting. The compensation point is well illustrated by the marshmallow experiment. Here, children were given the choice between eating a marshmallow now or waiting a short period of time and getting two. A surprising number ate the marshmallow now, indicating significant discounting of the future. Now that we have future values sorted, we can flip matters around. If we know an asset will give us $105 next year, what would we be willing to pay for it now? This is the present value. It is the inverse of our future value. Take our equation for the future value. Here, replace the R with delta to represent our individual discount rate. This tells us the individual is indifferent between our initial sum and this future value. Here, the initial sum is the present value we want to know, and the future value is our actual known number. So we rearrange the equation by dividing both sides by 1 plus the discount rate. Okay, what happens if the payment is in 2 years? Well, we have to discount twice, so we square the term 1 plus delta. In fact, this type of exponential discounting, or discounting at a constant rate, allows us to add together multiple cash flows through time by discounting them all to the present. What is the present value of the piece of paper we chatted about earlier? To work this out, let's add up the discounted sums at a discount rate of 5%.
$5 plus $5 divided by 1 plus the discount rate, which is 0.05. So that gives us 1.05 as the denominator, plus 5 divided by 1.05 times 1.05, so 1.05 squared, plus etc., etc. 5 divided by 1.05 to the power of 9. And if we add up this whole series, it's approximately equal to $40.54.
Now, this is a lot of stuff to type out, and it would get a lot worse if the piece of paper was paying $5 forever. I'm not sure I'd ever get the chance to stop typing out terms if that was the case. Luckily, this takes the form of a geometric series, and it happens to be one that converges to a fixed value. In this case, if the cash flow is received at regular intervals forever, we know that the present value of those cash flows is equal to 1 divided by the discount rate. Armed with that, if the piece of paper paid $5 forever at a discount rate of 5%, the present value of these payments would be $100. Or in other words, someone with a discount rate of 5% would value a payment of $5 a year forever at $100 right now. They would be indifferent between selling that claim for $100 or keeping the piece of paper.
Thanks, Gully. At the end there, you really struck on an important point. The present value of a stream of future cash flows is the amount where someone would be indifferent between keeping the asset that gives them the cash flow and taking an upfront amount of cash for selling the asset. We can think about this in terms of two choices, either having a stream of cash flows or a pile of money sitting there right now. This is useful for compartmentalizing this all in terms of our friend supply and demand. Imagine you start with a pile of cash. You would only be willing to spend that on an asset if the present value of the income you generate is at least equal to that pile of cash. This implies that this present value is the most you are willing to pay for the asset. You'd pay less because you value the asset at that amount, but you would not pay more. Now think about the flip side. if you had an asset that gave a series of cash flows, the present value of the asset is the smallest pile of cash that you would be willing to accept in order to give up the asset. If you were offered less, you'd want to keep it. If you would offer more, you'd want to sell it. As a result, the present value provides an individual's maximum willingness to pay for an asset they do not own, their demand, and the minimum willingness to accept for an asset that they currently hold, their supply. People's willingness to transact can differ for heaps of reasons, but we've said in this video that the only real thing we'll allow to vary is their discount rate. As a result of this, there will be buyers with smaller discount rates and sellers with higher discount rates, and we will have an equilibrium price for the asset where the discount rate between the marginal seller and the buyer is very close. The price where they transact will need to be between their willingness to sell and their willingness to buy, which will be very close given their close discount rates, and therefore ends up in the limit being equal to the present value. In the case with an infinite stream of cash flows, we can take this cash flow and discount rate and calculate the present value using our equation from before, the period payment divided by the discount rate. At the discount rate of the marginal buyer, this present value is equal to the price that the asset is sold at the price it transacts at. This is a very powerful result. The present value of the asset for our marginal buyer provides the condition which determines the asset price. Now, how do we know that this price makes sense? Well, if the price were higher, there would be additional supply of assets which would lead to sellers competing and driving down that asset price. If the price was lower, there would be additional demand for assets, leading to buyers competing and bidding up the price of the asset. Armed with this knowledge, we can answer the question from Twitter, which we had in our prior shorts. Here we are told that there is a regular $2 payment and that the asset price is $100. Before thinking about the tax, we can use this to work out what the discount rate would be. From our equation before, it will be 2 divided by 100, or 2%. This does assume that the marginal buyer would generate the same cash flows. It could be the case that other buyers would generate a lower return, and so the discount rate is itself lower. This isn't important for what we're discussing here, but if we were to compare capital income taxes to wealth taxes, this taxation of what's called a rent would be very important. Enough of the digression. In this case, we know that someone needs to be able to generate a regular $2 return from the asset in order to justify buying it. When we think of it this way, the imposition of the tax and related change in the price of the asset seems quite natural. A 2% tax on the value of the asset would leave zero return if it was levied on the initial $100 price. But we know the price will adjust to account for this. The price will need to adjust such that the post-tax yield from the asset is now over 2% again. We can work this out by simply taking our present value equation again and reducing the cash flow by the amount of the tax. Now, this is equal to the price of the asset, whatever it will be, times 2% or 0.02. Rearranging this gives us 2 over 0.02 is equal to 2 times the price of the asset, which will solve at the price is equal to 50. The 2% tax on wealth leads to the value of wealth halving relative to its pre-tax level. It doesn't collapse to zero, and it does not remain unchanged. In this case, the tax raised needs to be calculated from this new, lower asset price, which gives $1 of tax, not $0, not $2, and not some separate amount. Now, as we noticed in the short, this was the least popular answer, and we'll pop this up here as well. Something that surprised the person who popped up the poll, originally they deleted it and then put it back up because they thought people were trolling them. And it also surprised me a bit as well. However, I think it's instructive to think through how people may have only partially incorporated the price change into their logic, which is what the two shorts went and discussed. Ultimately, price changes aren't necessarily intuitive, And thinking through the logic about how prices can be determined is useful for thinking about how a tax can occur, and it's also useful for thinking through when the price change might not happen or it might happen in a different way. The introduction of present values and asset prices has allowed us to add a time dimension to our earlier discussions of exchange and choice by Mr. Mouse and Miss Kitty. Furthermore, it's allowed us to think a bit more deeply about wealth taxes and how changes in asset prices and the related revenue base may be a little bit more complicated than we normally think about. We've had a lot of fun chatting about these issues, and we hope this outline was useful for you. If you're interested in future videos on microeconomics, finance, and all that sort of jazz, especially inequality and taxation, then please come and join us here in the future where we can all chat about these. We'll see you all later. Bye-bye.